Hello, my name is Alexander Treves and I'm an investment specialist for JPMorgan Asset Management's Emerging Markets and Asia Pacific Equities Investment Team. And I'm here to talk to you today about the JPMorgan Emerging Market Research Enhanced Index Equity ETF, or JREM for short, seeking the best of active for the price of passive. Now, it's felt like a tough couple of years for emerging markets, because although there have been many good things going on, such as in North Asia, the AI-driven tech revolution, in India a somewhat overdue capex cycle, and more generally around the world, supply chain restructuring as people have relocated some of their manufacturing towards markets such as ASEAN, Mexico and Korea, China has had a tough couple of years. This is partly because of domestic policy, it's because of a contraction of the real estate market, and it's also because of the lingering after effect of some of what we saw from the COVID lockdowns. But we think that a lot of the challenges of China are being addressed now, and so we're optimistic that not only is the long-run picture very much intact, but also that we're going to have a more constructive couple of years going forward than we've had for the past couple of years. Now, if that sounds interesting to you, this is a product by which you can play that particular theme. And we have a research enhanced indexed fund, which has been packaged as an ETF, which you'll be very familiar with. But let me dig a little bit more into what research enhanced index actually means. And the key here, as you can see on this slide, is that we are combining active stock selection to drive the risk and the return in the portfolio with neutralized macro or style biases, and all of this with attractive fees. So really what we're giving you is the best qualities of both active and passive together in an REI ETF. For this particular fund, for JREM, the portfolio management team is on this slide. So you can see that on the left-hand side we have the portfolio managers, Lena and Sonal, and they conduct stock selection, they do the risk management, and they also engage in quality control. But then they are backed up, of course, by our world-leading team of research analysts managed by David and Giovanni. And on the next slide, you can see what all these analysts look like. And what we aim to do within the Emerging Markets and Asia Pacific Research Platform is gather the best of two things. We want the global breadth of expertise that they bring with local, on-the-ground insights in all of the different markets that they're based in. And this is an unparalleled resource in the industry, driving the ideas, which then fuel returns for this fund. The investment process then is that the analysts generate information advantage. So they are looking for the best stocks. And central to that process is our valuation model, which focuses on long-term fundamentals designed for inefficient emerging markets with multiple currencies. On the back of that, Lena and Sonal then construct the portfolio. The reason we place so much faith and emphasis on our expected return model, so the valuation methodology, is that as you can see here, over time it has really worked for us. And so the blue bars on the left are the stocks which have had the highest expected returns from that point in time, and the yellow bars in the center and the right-hand side of the slide are the stocks which have got less attractive expected returns. And after the event, what you can see is that typically stocks with higher expected returns have indeed done better than stocks with lower expected returns. So generally speaking, our analysts have done a good job of distinguishing the stocks which will then perform best from the stocks which will subsequently perform less well. We construct the underlying portfolio as you can see here. So on the left-hand side, these are the country positions of the portfolio versus the benchmark. And you can see that in China, Taiwan, Korea, etc., the portfolio is positioned very closely to the benchmark weights. So we're not taking a lot of risk at the country level. And in the middle column, you can see that the various sectors within China, so consumer discretionary at the top, but also financials or healthcare or industrials, there again, the portfolio positioning is very close to the benchmark weight. But it's on the right where we make the really important decisions, because this is the stock level within consumer discretionary within China. And this is where we're very careful to make sure that we overweight the stocks that we like and we underweight or avoid the names that we are less interested in. And so it's really that right-hand column which is driving all of the returns and the risk within the portfolio. When we put all of that together at the overall portfolio level, we achieve these portfolio characteristics. So starting on the top left, you can see that the portfolio has a price to earnings or a P ratio of 11.4 times, which is cheaper than the benchmark at 12.1 times. The return on equity of 12.7% is higher than the benchmark return on equity 11%, which is to say that we have a higher quality portfolio than the benchmark and cheaper. But the real key is the expected return number of 13.3% versus 11.8%. And you can see this again reflected on the top right of this page, where the expected return bar is by far the most important style tilt within the portfolio. So it's really the expected returns within the portfolio of all of these stocks which are driving the way that the portfolio looks. We have 404 names, so again, this is giving you index-like characteristics, but without being a passive fund. It's very well diversified. Over time, looking at the performance slide, you can see that this is an approach which has worked. Now, the last couple of years have been more challenging, and the next slide explains why that is. But we do believe that the longer run outlook for this asset class is very positive and that our approach will bear fruit. But let's understand what hasn't worked so well over 2022, 2023. So on the left-hand side, you can see environments in which typically we outperform. And these include periods of benign macro conditions, improving corporate earnings, and crucially, when higher quality stocks outperform lower quality stocks. Because as mentioned, we have a bias towards higher quality franchises. Conversely, we tend to find performance is tougher when we have macro conditions which cause corporate earnings to deteriorate, or when deep value or low quality stocks outperform. And really, that was a large part of the story of 2022 and 2023, when a combination of the well-documented headwinds that we saw in China, combined with a lower quality rally in India, really didn't work very well for the way that we tend to invest. So to conclude, our REI equity ETFs are designed to serve as core portfolio building blocks and an attractive alternative to passive funds. We have the investment expertise of our industry-leading team of analysts and portfolio managers. They target consistent alpha, exploiting stock-specific insights to seek incremental positive excess returns compounded over time with an index-like risk profile. So we think that this is an extremely attractive option for investors looking to add emerging markets to their portfolios with the aim of consistent alpha, an index-like risk profile, and crucially, of course, at low cost. If you would like to learn more, please visit am.jpmorgan.com/au or search for JREM Active ETF. Thank you very much.